So we are continuing our talk of job order costing. And chapters 2 and 3 kind of stay on this flow of job order costing and how we account for the costs through the process of manufacturing the goods. So we've got some terms we need to be aware of. So job order costing, we are aware of from last week, is a costing system used in situations where many different products or jobs or services get produced at the same time period, the same time span. Absorption costing is a costing method that includes all manufacturing costs, direct materials, direct labor, and both variable and fixed manufacturing overhead in the cost of a product. So job order costing, there's absorption costing. Then we've got what we talked about last week, an allocation base. This is going to be a measure of activity that usually is direct labor or machine hours that is used to assign cost to cost objects. So we've got to find out some type of method that we assign costs to different items. And there's this big overhead called manufacturing overhead that we can't really directly assign to specific products. So we've got to find a way that we can take all of these lumps of costs and add those costs to what it costs to make those products. Usually, companies will see how much indirect labor hours is assigned to a product, or if machine hours is a better avenue, we take machine hours. That's the allocation base. The predetermined overhead rate is the rate used to charge manufacturing overhead costs to jobs that is established in advance for each period. We come up with this predetermined overhead rate by estimates. Estimated total manufacturing overhead costs divided by our estimated total amount of the allocation base, what we estimate the total direct labor hours or the total machine hours to be. Because our costs don't come in until after the fact, we've got to come up with a way in which we assign these costs to these products. Then the equation for applying overhead is by overhead application, which is the process of assigning overhead costs to specific jobs using the formula overhead applied to a particular job is equal to predetermined overhead rate times an amount of the allocation base incurred by the job. We've got normal costing. This is a costing system where the overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of that job. And then we know a job cost sheet is that form we use that assigns the direct materials, the direct labor, and the manufacturing overhead to jobs. Okay? So we're moving on. We're going to first talk about the flow we have of costs in the job order costing system and how we prepare journal entries to show the flow of those costs. We know there's raw materials, there is work in process. Raw materials are the goods that are requisitioned from the warehouse in order to complete a project. The work in process is the product in process before it gets completed. Once a product is completed, it will go into still an inventory account, but an inventory called finished goods. Cost of goods manufactured includes the manufacturing costs associated with all goods that were finished during the period. So all of these are inventory accounts, but those inventory accounts are based on where the process is of the products. Raw materials are just raw coming in from the suppliers, ready to be utilized. So here you see the raw materials, the direct labor, and the manufacturing overhead are all product costs. Those costs flow with the products. Okay, they're an inventory asset account until they are sold. The balance sheet in a manufacturing company has a lot of different inventory accounts. There's a raw materials inventory account, and that's where these goods initially are put into. But when those goods are requisitioned from the warehouse to a specific job, they go out of the raw materials inventory account and they go into an inventory account called work in process. This job is being worked on now. It will stay in work in process and it will accumulate other costs while it's in work in process. It will accumulate direct materials and it will accumulate manufacturing overhead. Once the goods are completed, they will then be transferred from work in process and they will go into an inventory account called finished goods inventory. They stay in that inventory account until they are sold. When they're sold, they then get transferred from finished goods inventory into cost of goods sold. Cost of goods sold is basically an expense account on the income statement. Okay, so the key here is we have what's called product costs and we have what's called period costs. Product costs are the cost involved with making our goods that we're selling. Period costs consist of selling and administrative expenses. Those are what we call period costs. They are written off on the income statement in the period in which those expenses are incurred. They don't follow the products. They're not part of the product. They're part of the period. Okay? Selling and admin do not follow products. So, to illustrate the cost flows within a job order costing system, we're going to look at Ruger Corporation's transactions for the month of April. Ruger is a producer of gold and silver commemorative medallions, and it only worked on 2 jobs in April. So job A is a special minting of 1,000 gold medallions commemorating the invention of motion pictures. This job started in March and was completed in April. As of March 31st, job A had been assigned $30,000 if manufacturing cost which corresponds with Ruger's work in process balance on April 1st of 30,000. So the job started in March. At the end of March, work in process on job A was sitting at 30,000. Okay? Job B was an order for 10,000 silver medallions commemorating the fall of the Berlin Wall. This started in April but wasn't finished in April. So it's going to go into May. So you see here, raw materials, there's an account specifically for raw materials. As a job begins, those raw materials can go into one of two places. The direct materials go directly to the job. But those indirect materials, such as one of the examples is light bulbs or oil for machines, they're not really directly assigned to a job, but they're needed to run the equipment. Those indirect materials go into manufacturing overhead. But the direct materials that can directly be assigned to a job go right into the work in process of that particular job. So the purchase of raw materials in the journal entry form, on April 1st, Ruger had $7,000 in raw materials on hand. During the month, the company purchased an additional $60,000 of raw materials. You see, we debit the inventory account raw materials and we credit our payable. During April, materials requisition forms were prepared to authorize withdrawing $52,000 in raw materials from the storeroom for use in production. These raw materials include $50,000 of direct and $2,000 of indirect materials. So remember, direct materials get assigned to the job. Indirect materials go right into manufacturing overhead. Okay? So we debit those new inventory accounts and we credit our raw materials. Then we have labor. The labor is going to be assigned to a specific job or to manufacturing overhead also. The direct labor that is assigned to a specific job goes into that work in process. That which is indirect labor is going to also go into manufacturing overhead also. Okay? Then, in April, the employee time tickets, which provide hourly summaries of each employee's activities, included $60,000 recorded for direct labor and $15,000 for indirect labor. We would show $60,000 would go directly to jobs, $15,000 because it's indirect labor would go into manufacturing overhead. Okay? Here we show our T accounts showing that the payable will be offset into both inventory accounts, one be at specific jobs through work in process, one be at manufacturing overhead. Okay? Now, assume that Ruger Corporation incurred the following general factory costs during April. Utilities, rent, utilities, heat, water, power, rent on equipment, and miscellaneous factory overhead. The 21, the 16, and the 3 totals are $40,000. All of these items are indirect materials or indirect costs that will go into manufacturing overhead. Does that make sense? Okay, so that's going into manufacturing overhead. Now, this manufacturing overhead is just the costs, the actual costs are getting debited to manufacturing overhead. Those are actual. But then we're applying this manufacturing overhead to jobs. And it's basically on a predetermined rate because we only can do it based best on what we know. So we're always having an over or under applied manufacturing overhead. If actual and applied manufacturing overhead aren't equal, well, then we have to adjust it at the end of the period so we make them equal. We've either assigned too much or too little manufacturing overhead to a jobs. So we're constantly playing catch up. Okay? Assume Ruger Corporation's predetermined overhead rate is $6 per machine hour. Also assume that during April, 10,000 machine hours were worked on job A and 5,000 machine hours were worked on job B, a total of 15,000 machine hours. Thus, 90,000 in overhead costs would be applied to work in process. The following entry shows how we would apply it. We would debit our work in process and credit our manufacturing overhead. Remember, items that are considered non-manufacturing overhead get expensed right to the income statement in the period in which they incur. Salaries of employees who work in marketing, selling, or admin, and advertising expenses are period costs. They will never follow the products. Okay? Never follow the products. Got it? Okay. So, Ruger's incurred $30,000 in selling and admin costs during April. It's going straight to the income statement. Salaries expense, salaries payable. Depreciation on office equipment, depreciation expense, accumulated depreciation. Now, guys, if this was equipment in the factory, then that would be a manufacturing overhead expense, wouldn't it? But if it's office equipment, it's a period cost. Advertising was $42,000 and other selling and admin expenses totaled $8,000. Do you see how those aren't getting put in inventory? They're going right as an expense into the income statement. Got it? Yes. So depreciation is an estimate also. So basically, there are guidelines as to how long certain items will last. So furniture and fixtures, they say, should last 7 years. Equipment oftentimes is 5 years. It's usually we have guidelines accountants use in order to determine what depreciation is, such as, buildings are a certain amount. If it's a barn type of building, it's for 10 or 15 years. If it's a house, it's usually 27 and a half years. If it's not a residential property, it's usually 39 years. So we're told what to use. You can go against it if you have reason to go against it, such as computers. No computer is going to last me 5 years. Maybe an Apple will for you guys, but usually my computers last me a year because I buy a Dell. I'm not trying to cut down Dell. I'm just really hard on it. So if I have a reason to alter from the guidelines, you can. You just have to have your explanation. Well, basically, when you're a public company, you have to have audited financial statements each year. So that company that's auditing the corporation is going to make sure that they're adhering to what we call generally accepted accounting principles. And if they're not, then they're not going to get a clean opinion because we all need to adhere to the same standards. That's what makes our financial statements readable and comparable because we're all following the same guidelines or should. Okay? Okay, so as you see here, these period costs go right as an expense onto the income statement. Now, once the job is complete, it's going to go out of work in process and it's going to go into another inventory account called finished goods. So this is the cost of the goods manufactured that have been completed but haven't been sold yet are going to be transferred from all those jobs, what we are labeled in work in process, into finished goods. Job A was completed during April, and job B was incomplete at the end of the month. So the following entry transfers the cost of job A from work in process to finished goods. Remember, because they're done now. They're ready to be sold. So this credits the work in process account they were in and now debits a new inventory we call finished goods. Okay, so because job B wasn't completed, it's still all sitting in work in process. Remember, it will stay in that account until the job is complete. Now, when those items sell, they then get transferred out of any inventory account, and in this particular account, finished goods, and we then show them as an expense on the income statement, cost of goods sold. Okay? You guys learned some of this in financial accounting, right? For Ruger, we assume 750 of the 1,000 gold medallions in job A were shipped to customers at the end of the month for total sales revenue of 225,000. Because 1,000 units were produced and the total cost of the job from the job sheets was 158,000, the unit cost is $158 per unit. So we're only showing, taking out of finished goods and putting into cost of goods sold, those medallions we actually sold. So we still have some of those medallions sitting in finished goods. Make sense, guys? And we know when we're dealing with manufacturing products or any products, we buy them or we produce them at one price, but we sell them for a higher price. That's how we make a profit. So you see our sales is 225 and the cost of those goods here is 118.5. So let's look at a problem. Okay, doesn't this help to kind of see what we're doing? Polaris Company uses a job order costing system, and we have these various transactions that happen. So we're going to go through the process of recording these transactions. So raw materials that were purchased on account, we would show going right to the raw materials inventory account, debit raw materials of 210, we credit our payable of 210. Then they requisitioned $190,000 of raw materials. Now they're real clear to say 178,000 of those were direct materials, which they went directly to specific jobs. So we'll know 178 was debited to work in process. 12,000 went right into manufacturing overhead, because remember that manufacturing overhead is a huge big grouping of all these costs we need to assign. And what got credited from that was raw materials. Okay? Next, accrued direct labor cost of $90,000 and indirect labor cost of $110,000. Remember, if they're direct, they go into work in process. If they're indirect, they go into manufacturing overhead. Then we have depreciation recorded on factory equipment. That's all going to be manufacturing overhead. It's not assigned to a specific job. Then, other manufacturing overhead cost accrued during October, $70,000. We debit our manufacturing overhead and we credit our payable. Then the company applies manufacturing overhead to production using a predetermined rate of $8 per machine hour. Remember, this is where we're offsetting our manufacturing overhead to assign them to jobs. So that work in process gets debited $240,000 and our manufacturing overhead gets credited $240,000. Okay? Next, jobs costing $520,000 according to their sheets were completed during October and put into finished goods. So we'll credit our work in process and we debit finished goods. Then it says jobs that cost $480,000 to complete were shipped to customers. And those jobs were sold on account at 25% above cost. So we take out of finished goods and transfer to cost of goods sold the cost of those. And then we show the accounts receivable debited, the sales credited of that cost plus 25%. Does that make sense? What we're doing here is seeing the flow of the goods. Okay? Here, we are posting all of those different transactions straight to the accounts manufacturing overhead or work in process. Do you see here that we over-applied the manufacturing overhead, which means the actual costs were less than what we applied to jobs? Okay, we overkilled. Got it? We see we have 30,000 still in work in process that have not been completed during the period. Okie doke. Do y'all want to go through another one? Would that help, or do you want to move on? Is that okay? So, now we're going to look at preparing cost of goods manufactured, cost of goods sold, and the income statement. So a cost of goods manufactured and cost of goods sold will show direct materials, direct labor, and manufacturing overhead. It's going to calculate the cost of the raw materials and direct labor used in production, and then the manufacturing overhead that gets applied to those jobs. The manufacturing costs associated with goods that were finished during the period. So again, oh, I got to turn this off. It's driving me nuts. Let me turn the volume down. So as you see here, you can see that raw materials made during the period get added to the beginning raw materials account. Okay? So we start with a beginning raw materials balance. We add the items purchased during the period to the raw materials account, and we come up with what's called raw materials available for production. That minus our ending balance of raw materials is what we basically transferred into work in process, right? So raw materials used in production is part of our manufacturing costs. As items are removed from raw materials inventory and placed into the production process, they are called direct materials. Okay? Then, direct labor that's being used in production and manufacturing overhead applied to production then get added to the direct materials, which then allow us to arrive at total manufacturing costs. Direct materials plus direct labor plus our manufacturing overhead equal total manufacturing costs. Then those total manufacturing costs get added to the beginning work in process to arrive at total work in process. The ending work in process inventory is deducted from the total work in process for the period to arrive at the cost of goods manufactured. This is an important table to be reminded of when we do these schedules. We're going to follow this example. The cost of goods manufactured is added to the beginning finished goods inventory to arrive at the cost of goods available for sale. But the ending finished goods inventory then gets deducted from this figure because that difference is going to be cost of goods sold. So our finished goods beginning inventory plus our cost of goods manufactured gives us our cost of goods available for sale minus our ending finished goods inventory is what was sold. Okay, guys, I want y'all to look at this. Beginning raw materials inventory was $32,000. During the month, $276,000 of raw materials were purchased. A count at the end of the month revealed $28,000 of raw material was still present. What is the cost of direct material used? How are we going to figure that out? You want to say C? How many agree? Perfect. Beginning inventory plus purchases equal what's available minus our ending gives us raw materials used in production. Excellent. How about this one? Direct materials used in production totaled $280. Direct labor was $375 and $180 of manufacturing overhead was added to production. What were the total manufacturing costs incurred? What do y'all think? B, 280 plus the 375 plus the 180. Okay. Beginning work in process was 125. Manufacturing costs added to production for the month were 835. There were 200,000 of partially finished goods remaining in work in process inventory at the end of the month. What is the cost of goods manufactured during the month? Wouldn't it be 760? Okay. Okay, last one, guys. Tell me what you think. Anyone? What? B? Awesome. Beginning finished good inventory was 130. Cost of goods manufactured was 760. And the ending finished goods was 150. So the difference is what's going to be sold. Okay. Here, schedules of cost of goods manufactured and cost of goods sold along with the income statement. Here we have all kinds of data. What we need to do is prepare a schedule of cost of goods manufactured. Assume all raw materials used in production were direct materials. So cost of goods manufactured, we're going to start, remember, we're going to start with our raw materials, our beginning inventory. We're going to add the purchases and then show what's available. So here you see, prepare a schedule of cost of goods manufactured. We start in this scenario with our beginning work in process. We add to that our direct material beginning balance plus what was purchased, totals what's available. Minus that ending inventory shows those raw materials were added to production. We add to that our direct labor and our manufacturing overhead that was applied to give us total manufacturing costs. Okay, so we've got our 280,000 total manufacturing costs minus our ending work in process should be what we manufactured. Got it? Then, in order to complete a cost of goods sold statement, we'll have our beginning finished goods inventory. We're getting our cost of goods manufactured from our schedule of cost of goods manufactured to give us cost of goods available for sale minus our ending finished inventory is going to give us what we sold. Right? Then, in this case, since we over applied our overhead by 10,000, we're going to adjust our cost of goods sold. We over applied overhead. So, since we over applied overhead, we assumed the cost of goods sold were greater than what they really were. Therefore, we are showing our adjusted cost of goods sold are only 250, not 260, because we assigned more cost to our cost of goods sold than really was there. Okay? The income statement will then take our sales, minus the cost of goods sold gives us our gross margin. We take our selling and admin costs to come up with our net operating income. So what's helpful here is to be aware what our period costs and what our product costs. Okay? Now, under applying and over applying overhead costs and how we go about determining that. The difference between overhead cost applied and over applied to work in process and the actual overhead cost of a period is either going to be under applied or over applied. Under applied is when the actual costs are greater. Over applied is when the actual costs are less than what we actually assigned to the various products. Got it? So in this case, Pear's actual overhead for the year was $650, with a total of 170,000 direct labor hours worked on jobs. Pear's predetermined overhead rate is $4 per direct labor hour. So actual 170,000 times the predetermined overhead rate of 4 means we applied to various jobs $680,000. But if actual is only $650, didn't we over apply the overhead? So since we've over applied this overhead by 30,000, technically our cost of goods sold is what we're showing the cost of goods is actually 30,000 less than what we're showing. Okay? Pearco has over applied overhead for the year of 30,000. What are they going to do? They're going to do a journal entry to adjust it, aren't they? How about this one, guys? Tiger has manufacturing overhead cost of $1,210,000 and a predetermined overhead of $4 per machine hour. Tiger worked 290,000 machine hours. So Tiger's manufacturing overhead is what? So 290 times 4 is what? I would say it means they underapplied. Yeah, I get it. Yep, you're right. They underapplied it because the actual costs are greater than what was assigned to the products. Okay? Any remaining balance in the manufacturing overhead account, such as Pearco's 30,000 of overapplied overhead, gets disposed by either closing it to cost of goods sold, or we can proportionally assign it to the various accounts. It can proportionally go into work in process, finished goods, and cost of goods sold. Okay? The journal entry to close out Pear's 30,000 of overapplied overhead would be, we debit the manufacturing overhead to zero it, and we'd credit the cost of goods sold, which would basically reduce the cost of goods sold. We had it too high. Okay? Calculating the allocation of underapplied or overapplied between the different accounts, let's assume the overhead applied to ending work in process inventory, ending finished goods, and cost of goods is 68, 204, and 408, actually totaling 680,000. We would prorate it then. So we would show the ending WIP, we'd give 10% of that 30,000 to ending WIP. We would give 30% to ending finished goods and the difference to cost of goods. Okay? The allocation of the 30,000 would then show 3 would go to work in process, 9 would go to finished goods, and 18 would go to cost of goods. Here you'd see how we would do it. We'd debit our manufacturing overhead since it was over applied, and then we're crediting all those accounts to reduce them. If it was underapplied, we'd be doing the opposite. There are 2 methods for disposing of underapplied or overapplied. Bring it right to cost of goods sold or allocate it. Okay? Much more accurate to allocate it, just depending on how much we're talking. What effect will the over-applied overhead have on net income? It's going to increase, won't it? Because if we over-applied it, it means we made the cost of goods sold greater than what it really should have been. Sometimes you just think it through, you know. If it's over-applied, that means we're having to debit the manufacturing overhead, which means we're ending up crediting cost of goods sold, which brings it down, okay? Osborne Manufacturing uses a predetermined overhead rate of $18.20 per direct labor hour. The predetermined rate was based on a cost formula that estimates $218,400 of total manufacturing overhead for an estimated activity level of 12,000 direct labor hours. The company actually incurred $215,000 of manufacturing overhead and 11,500 direct labor hours during the period. Determine the amount of underapplied or overapplied manufacturing overhead for the period. So what's it going to be? 11,500 direct labor hours times 1820 is 209,000. But you see the actual overhead is greater. So in this case, we underapplied it. So we showed the cost of goods to be less than what they really should have been. Assume the company's under or overapplied is close to cost of goods sold. What would we do? We would debit our cost of goods sold by $5,700 and credit our manufacturing overhead ultimately. Okay? It's going to reduce our net income. Is this clicking, guys? It's pretty straightforward. So here, Harwood uses a job order costing system that applies overhead costs to jobs on the basis of machine hours. The company's predetermined overhead rate of $240 per machine hour was based on a cost formula that estimates $192,000 of total manufacturing overhead for an estimated activity level of 80,000 machine hours. Assume that during the year the company works only 75,000 machine hours and incurs the following costs in the manufacturing overhead and work in process. So if they really only work 75,000 times 240, 180,000 would be being applied, wouldn't it? Right? And how much did we actually spend? More than that 180. You see that balance is 4,000 there? So, because we underapplied it, we would have to show more cost of goods sold. Explain why the manufacturing overhead was underapplied or overapplied. When overhead is applied using this predetermined rate, It's assumed the overhead cost is proportional to machine hours. But when the actual machine hours turns out to be 75,000, then there's a drop in the initial estimated manufacturing overhead. So basically, our machine hours ended up being a lot less than what we had anticipated. So, guys, pretty straightforward chapter. Let's look at a problem. See how you're doing. We'll spend time working on one problem. Spinning up a storm. Okay. So here we've got chapter 3. Bless you. Okay. Let me just see that one. Let's look at this Gitano Products. Uses a job order costing and applies overhead costs to jobs based on direct materials used in production, not on the basis of raw materials purchased. Its predetermined overhead rate is based on a cost formula that estimated 800,000 of manufacturing overhead for an estimated allocation base of 500,000 direct material dollars to be used in production. The company provided the following data, so it shows us the beginning balances of all these accounts, ending balances, and what was purchased and added to the various items. The first thing we're going to do is compute the predetermined overhead rate. So we know it's telling us cost formula 800 of manufacturing overhead for an estimated allocation base of 500,000 direct materials used in production. So basically they're going to say 800 divided by 500 is 160%. So they're doing the allocation based on materials. That's different, but that's how they're doing it. Then number 2 asks, compute the amount of underapplied or overapplied overhead. We've got to first determine what was used in production. So do you see, you start with your beginning raw materials, you add your purchases, subtract your ending balance to come to figure out what went into production. Then we add all of our costs the actual manufacturing overhead here, our indirect labor, property taxes, depreciation of equipment, maintenance, insurance, rent, and then we offset that with what was our allocation base, 160% times our 450,000. So 40 is, we put 720,000 into manufacturing overhead applied, but we under applied it by 40,000. Okay, so in this case, our under applied overhead here is 40,000. The cost of goods sold before the amount we didn't under applied, you start with your beginning finished goods, you add what was manufactured, subtract your ending finished goods inventory to find out what was sold. Then, in this case, they're going to take the under applied overhead can be closed out to cost of goods sold or allocated between the three different ones. Yes. Number 2. This is number 2 homework. Gitano products. How could half the information be different? Is this a... Fall 01 23 homework preview. You don't see that on number 2? Anyway, move. What? So as we move down here, guys, in this case, you can allocate it just to cost of goods sold, or they can allocate it to the three different under applied can be closed either to cost of goods or allocated between the three. Okay. Last, the amount of overhead work in process was 24,000 of direct materials times the 160% manufacturing overhead. So you see here the ending work in process, subtract the direct materials and the manufacturing overhead, or excuse me, add those two together. The difference is your direct labor cost. I'm going to give you, let's just go through one more and then we'll end the slide here. Let's do number 4. Dixon's a manufacturer who completed numerous transactions during the month. So we've got various transactions. The table shown below includes only one account from Dixon's balance sheet, retained earnings. For each of the above transactions, select no if it doesn't affect retained earnings, but also if the transaction does affect retained earnings, then record the amount of the increase and decrease to this account. So A, raw materials purchased on account. That's not going to affect anything. It's just an inventory. Raw materials used in production. That's going into work in process, still an inventory account. Sales commissions paid in cash, 45,000. Remember, those go directly to the income statement, don't they? And wouldn't that decrease our net income by 45,000? Yes? How about depreciation on assets? 65% related to factory equipment, and the difference remaining to selling and admin. Wouldn't 35% of 60,000 affect the income statement? E, sales of 450,000. It doesn't matter if it's cash or on account. It's all income, right? J, various completed jobs costing 220,000 were sold to customers. Wouldn't that 200,000 go into cost of goods sold? Make sense? Okay, guys, I'm going to end this.